This fund invests in emerging market bonds of all kinds. Emerging markets consists of almost 90 countries around the globe outside of the likes of Europe, America, Australia, and Japan, which we call developed markets. And within those 90-odd countries, we invest in government bonds in both local and hard currency, and in the bonds of various companies and banks located in those countries. So it's very much a go-anywhere, best ideas fund where we can express our views quite flexibly. Our investment process is country-driven and it relies on bottom-up research. We are fundamental medium to long-term investors. So the approach is first to decide which countries we want to be in, and that decision is made having made detailed analysis of the countries in question from economic, political, and governance perspective. And once we decided which countries we like, within those countries, do we want to be in government bonds, hard currency or local currency? Do we want to be in a bank or a corporate within that country? And if we do, then we do detailed bottom-up analysis on those entities to ensure that we are buying the bonds of companies we're happy to hold for our clients for an extended period of time. So the main risks are country risk, credit risk, and currency risk, and up to a point duration and rates, although we don't take large duration positions. The main mitigants are, one, a rigorous bottom-up research process. Such we are medium to long-term investors, so we need to have confidence that we can invest in these bonds and hold them for a considerable period of time, which means we need to have confidence in the credit. So we set great store by our rigorous research process, and we have a large research team backing us up. And another one is diversification. The portfolio is highly diversified. And the position sizing is such that if one bad call is made or something goes wrong somewhere, that one position is not going to materially detract from performance for our end clients. We're not taking big bets and relying on one big bet here and there to drive performance. We are reliant on the rigors of our process to build performance consistently over a period of time by making multiple good calls in smaller size. And that, again, mitigates the downside risk, which in the world of bonds is well worth doing, because unfortunately, in the world of bonds, downside is much larger than the upside than in other asset classes, although less likely to materialize. In this particular fund is what we call Article 6, which means it doesn't have ESG criteria. However, we run several other funds which do have ESG criteria, and we are obviously looking at the same countries, the same companies for those funds which do incorporate ESG. So a lot of the investments in this fund will go through the same ESG screen that we use for the other funds, but in this particular fund, we are not bound to follow them. It's a very good diversifier because it encompasses most of the world, as I say, outside the Western world and Japan. And it adds a good bit of yield because of that. People think of emerging markets as a risky place, but it includes countries like, for example, the Gulf states, which are rated single A or double A. It includes the likes of South Korea. It includes the likes of Israel, again, an A-rated country. So you are getting paid more per unit of risk that you take than you would in an equivalent developed market fund. And it's a much more diversified opportunity set. So you spread your risk around more, you can express your views much better. And you have within the portfolio, by the highly diversified nature, you have natural hedges in that if something is going wrong in one part of the world, something is usually going better in another part of the world. So you don't get the concentration of bad news or good news that you would get if you were invested only in the Western world. So it adds yield. It's attractive on the risk-reward basis, and it's highly diversified, and therefore, actually, to give you an example from my own coverage, which is banks, emerging market banks over the last 10 years have delivered higher returns than developed market banks with lower volatility, which is a fact that I think is one that's well worth taking notice of for people who are considering emerging market investments.